Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be going over Apple stock, Microsoft stock, and then basically the market in general. Specifically, we're going to be focusing on tech stocks and the NASDAQ. We're going to be going over the market cycles. We're going to be going over how the cycles that go through the market is showing an extreme similarity between what's going on now, and so we're going to compare that to the S&P 500 and the NASDAQ today. We're going to be going over the performances of the three indexes, the Dow, the S&P 500, and the NASDAQ. And then we're also going to be looking at some performance on price and then some valuations of a lot of the large tech stocks. And then I'm going to be going over similarities and differences between 2000 tech bubble and what we are in today in 2020. And then last but not least, I'll also be going over some information that I found in this article that I thought was really interesting. So overall, guys, if you don't know me and you don't know who I am, my name is Jordan. I'm the Millennial Investor. I track my dividend income here, my annual dividend income, my monthly dividend income, and my portfolio value. The reason why I wanted to focus on Apple and Microsoft is for two reasons. The first one is if we click Research tab here and then we go to Stocks, they're obviously the two most valuable companies on earth. They make up the most weight in the market, and everybody has their eyes and attention on them at all times. And the other reason why I wanted to point that out is I don't own a lot of tech stocks. There's one tech stock that I really believe in. I like its valuation. I like its dividend yield. I like its dividend growth. But other than that, I don't really own a lot of growth stocks. I mostly own three in my portfolio. I own Visa. I own Microsoft right here at 3%, and then Apple, 2%. So these two only make up 5% of my portfolio, these two tech giants. And a lot of people put them at 10, 20, 30, 40, 50% of their portfolio with just these massive tech giants. So I believe in the future a lot more with Visa and its growth opportunities there and its dividend growth than I do with Microsoft and Apple. Now that said, I really do like these companies, and that's the reason why I own them is because I think that their long-term growth potential will be great for their dividend. But that said, I think that this valuations that we're starting to get at are starting to get pretty ridiculous for tech in general. Just to highlight some of the ones that I pointed out here, so let's just pull up some ones that are doing incredibly well. Nvidia, over the last 5 years, 1,640% performance growth. Shopify, its 5-year performance is 2,400%. Amazon, its 5-year growth is 513%. Facebook is up 166%. Google, we can keep on going. Google is up 164%. And the cycle just goes on. And the same thing with Apple, up 211. Microsoft is up 330%. You see the trend here. Nearly all of the major tech stocks and all the names that I just pointed out are huge companies. We're not talking about some small cap, $1,000,000 or $1 billion company. These are maybe even hundreds of billions, and even some of them trillions of dollars. So this is not easy to move the stock price this much when these companies are weighted this heavily. So if we go ahead and click the research tab here and then we go ahead and type in SPY. So this is the S&P 500, and I want to show some similarities here, and I want to show you the differences between the S&P 500 and the NASDAQ. So if you don't know, the S&P 500 covers pretty much all factors of the market. For me, I always mention in my videos, those of you that watch my previous videos, I like to watch the S&P and get a good idea on the S&P on how the market is doing. I think it gives the best representation on what the market is doing. So with the S&P, it has all different types of sectors like technology, like utilities, industrial, consumer. There's all different types of sectors that S&P covers. And the great thing about the S&P is that it covers just the top 500 companies regardless of what sector they're in. They can be tech companies, they can be industrial companies, it doesn't matter, whatever, just the top 500 companies. So I think this gives a great representation of what the market is really at. So you see this cycle here. Specifically, let's look at the 2-year chart. So we had a little correction in the market in 2018 when the trade war was supposedly going to happen. And then you see this little bit of euphoria here where the market recovers and then everybody gets excited and then it goes in just this parabolic state where it just is pretty much a straight line up every single day. So if you see the market cycles here, you see the takeoff, the first sell-off, the bear trap. This is what we were in 2018. This was the trade war that took the market down. I think it was 18% for the S&P. And then you see the media attention, enthusiasm, greed, delusion, and then you can see we hit that spot with delusion right there, if I can click it, delusion right there where we just went in a straight line up. Do you see some similarities here? The first bear sell-off, the bear trap, and then we have the media attention, the enthusiasm, all different types of stuff like that, and then we got to the point of delusion. Seems pretty similar. Now let's go to where it starts falling. Denial, bull trap, return to normal. Okay, so denial right here, bull trap right here, return to normal right here. And then we know what happened after that. You see here, fear, capitulation, despair, and then return to the mean. So you can see it stops the that it stops the chart at return to the mean, so you can see that it's denial and fear, and then it goes down to the very bottom, and that is at the utmost fear where people are selling any and all stocks regardless of what sector they're in, regardless of their profits, and everybody's just fleeing for cash. And then now, as we get back here, a lot of people are still expecting a second crash, as we're getting to this point right here, when the S&P is about 280, 290, and then people are selling out of their stocks. People are just, oh, the market's going to have a second downturn. I'm going to try to time the market. I can think of large YouTubers that I know that have hundreds of thousands of subscribers that were selling their stocks in this area right here because they thought there was going to be another market crash. And then we went up higher, higher, and we almost reached another new all-time high. And so the question is, we're getting to the point right now, is this a bull trap or a bear trap? And if we go to the QQQ or the NASDAQ, the QQQ or the tech ETF is at an extreme all-time high. It peaked at about $235-ish back in February, March of 2020, and now it is a $253 index. So you see with the NASDAQ, specifically the NASDAQ holding a lot of tech stocks, you can see it's getting back to this point of this enthusiasm, greed, delusion stage right here. We're just going in this straight line up. Do you see a pattern here? Am I crazy? Do I see this exact same pattern happening over and over again? It happened in 2000. It's happened in other stages as well, but I'm beginning to see a pattern here. Now let's go ahead and look at the one-year performance for the Dow, the S&P 500, and the NASDAQ. The Dow 1 year is down 3.73%, okay? The S&P 500 is up 6.11%. And then the NASDAQ, the QQQ, is up 37.18%. It is over 31% higher than the S&P. Over 40% higher than that of the Dow. Just think about that for a second. Regardless, before we talk about valuations, growth of these stocks, the defensive nature of these tech stocks in 2020, just look at that performance and tell me what you think. Now, if we go to valuations for a lot of these big tech stocks, it gets really interesting. The stocks that I included in this list, I wanted to only include large tech stocks. Like, for example, one smaller tech stock that I like to watch is TTD. I think the Trade Desk has a very long-term growth story, and it has an incredible performance over the last 5 years. But it's a $19 billion market cap. It's not one that I am interested in. I can think of other stocks that I can think of, like Cloudflare. I've heard people talk about that one, has a huge growth opportunity there, but it's only an $11 billion market cap. I want to talk about stocks that have huge weights in the market. So those Cloudflare stocks, the Trade Desk stocks, those stocks can be moved easily. With the Trade Desk, what is it? What did we say, a $19 billion market cap? It can be moved its stock price pretty easily because it's only a $19 billion market cap. If a hedge fund wants to start buying the stock heavily, it will begin to move the stock price. Now, a stock like Apple that has a $1.7 trillion market cap, buying 1,000 shares is not even going to budge the stock price. So this is not easy to move this stock. Now, if you notice with all these, the stocks that I picked, Apple, Microsoft, Nvidia, Amazon, Square, Shopify, all of these stocks are extremely weighted in the market, and all of them on the first line, if you see here, near or at an all-time high. So the PE ratios is what we're going to look at. The PE ratio is price to earnings ratio, for those of you that don't know what that is. Basically, it represents the value of a company, the earnings. It does not represent the revenue that they make. This is the profit of a company, so their earnings. So the price to earnings ratio, the higher that number is, the more overpriced that stock is and the more you're paying for your money. So with Apple, it is about a 31 PE ratio. Microsoft is a 36. Nvidia about a 50. Now let's stop right here. 31, 36, that's a little high, but okay, that's pretty understandable for some high growth companies like this. They have an extreme amount of profits and a lot of growth priced in ahead of them. So 31, 36, not bad. Now we get to Nvidia, we're at 50. Okay, it's starting to get a little high priced. I don't think I would pay 50 PE ratio for hardly any company. And then we get to Amazon. Amazon is at 164. Amazon has so much growth priced ahead of it that it's beginning to get priced at a $1.5 trillion valuation when it is not supposed to be there yet. Now, I know a lot of these companies have grown massively, and the share price performance does not reflect future performance. This stock is at 3,000 now. It could be at 6,000 next year. There's no way of knowing, and I am not a hater on any of these tech stocks. Like I said, I own two of them. I own Apple and Microsoft. Nvidia is a stock that I've actually considered buying, and Amazon is a stock that I love. I love every single company on this list. I'm just trying to give you an idea of valuations of what they look at. Amazon, 164 PE ratio. For a stock to be priced at 164 PE ratio, it should be growing well into the double digits, 10, 20, 30, maybe even 40% every single year. And for a company this size, while it will have pretty good growth, the question is how long will that last? So people are pricing the stock at where it's probably going to be valued at 2, 3, 4, 5, 6 years down the line. Now that said, I do love this company, but it's starting to get a little bit ridiculous. We look at Square stock. The PE ratio for this is 445. 445. We pull up Square stock. Basically, all they are is a payment system. Now, I do think that they have a lot of opportunities ahead of them. I own Visa, which is a very similar business model to Square, but it's getting priced at levels that are getting a bit ridiculous. A 445 PE ratio for any company, regardless of the growth, regardless of the opportunity, is a bit high. Next up, we have Shopify. Shopify, it's really in a class of its own. I have never seen a stock just outperform everything like Shopify does. Now, when you see a stock like Shopify, let's not talk about this business model. Let's not talk about the opportunities, the growth story ahead. Let's just look at the stock chart. Let's pretend you didn't know what the stock was and you just saw the stock chart. What do you see when you see this? I see greed, I see euphoria, and I see a whole lot of fear of missing out, a lot of FOMO. So if you're wanting to buy this company, if you like this company, if you're wanting to buy it during the dip, if you're wanting to buy it here when it was $300 a share, get after it. If you're wanting to buy it here in 2019 when it was under $300 a share, when it was $290 a share, get after it. But if you're wanting to buy this company and you believe in it, why would you buy it at $1,000 plus? And more importantly, the PE ratio is 1,940. This company just recently became profitable. They have very, very low profits. They've been an unprofitable company for years. And their 1-year performance year to date is 227%. 227. Now, one company that I just went over recently, I had a lot of people comment to me on this video. Tesla is up 547%. Now, what I said with Tesla is the same thing I'm going to say with Shopify. If you believe in the company long term and you think it's going to do great things, I do with Tesla, go ahead and buy it, whatever price you believe in it at. If you buy it at $1,500 and you think one day it's going to be a $3,000 stock, get after it. But why not probably wait until a better price, or maybe even just avoid these stocks in general where the price is starting to get a little bit unrealistic? If you see a lot of the companies that I own, like for example, my number one holding is Broadcom, and it's one of the best performers in the last 5 years. It's doubled, and it's had huge dividend growth. Its PE ratio is not anything that's completely out of hand. And if you compare it to a lot of my other companies, it is not even anywhere close to this. Only 31% in the last 5 years. A PE ratio is not anywhere close to that. And then if you look at my third largest holding here, it's a utility company. So with the utility company like Southern, it's only up 24% in the last 5 years, and its PE ratio is significantly lower than that. This is a need-based product. Now, let's go over the similarities and the differences between these two. Valuations are starting to become irrelevant. So the similarities, what happened in 2000, people were buying any and all stocks that basically had .com after, and that's why it was called the .com bubble. People are buying these stocks regardless of their valuations. Just like I said with the Shopify here, they no longer care what the valuation is. They care what the story is about. Now, I want to give you an example for a stock, SPCE space Virgin Galactic stock. You see the year chart on this. Everybody had a great story for the stock, and we're buying the stock with FOMO, greed, all the stuff, and it was almost $40 a share. And then what happened about a month later? $10. 60-70% downturn in the matter of a month. And it's pretty much went nowhere since. Right now we're sitting at about 17 bucks. So if you're buying the stock at $37 a share, if you're buying the stock at $40 a share, and today it's at 17, you're down 50, 60, 70% on your money. So I'm wondering if that's going to happen with Shopify as well. Now, Shopify is a lot different than Space, but I would just want to give you an example. Euphoria, greed, and FOMO that is happening pretty much with all the tech stock like I've been showing, a bit too forward-looking. So what the market does, it doesn't matter what company you're talking about, the market does not price the stocks off of what's happening today. It's pricing stocks of what's going to happen in the future. How far into the future? Well, that's where it starts to get interesting. If you see the year stock chart here, you can see in February, this was before the shutdown was happening. And this right here is when the downturn started happening, where people started getting worried. And a lot of shutdowns really didn't start happening until March, April, and sometimes even into May. So a lot of this was already priced in. A lot of the pain and fear was priced in March. And then as we get further and further along here, the market is forward-looking. While shutdowns are happening, coronavirus cases are skyrocketing, all different types of horrible stuff is happening in the market. And then if you look at the stock chart here, right here through May, June, July, while the Rona is getting priced in and all these cases are rising as high as they can, the economic data is coming at horrible numbers. The market is looking forward. The market is looking at, we're going to get past this, we're going to get back to all-time highs, and we're going to go ahead and start buying the stock now to get ahead of that. But for a lot of these stocks, not like the S&P, like for example in Amazon, they're pricing in growth that is years ahead of it. Amazon, is it a great stock? Does it have a lot of growth potential? Sure. But should it be up 513% and should it be up 60% on the year? You can see its all-time high here was $2,170. Today it's over $3,000. So it is being a bit too forward-looking and pricing in growth that is a bit too extreme. It is pricing in years worth of growth in the matter of weeks and months. Now another similarity to this is that tech is just generally speaking the most exciting sector. Now the cool part about tech is if you compare it to like a Coca-Cola, for example. Coca-Cola is a stock that I own, that I love. It is only up 10% in the last 5 years, but I like Coca-Cola. It's predictable, it's easy, it's basically free money if you're wanting to investing in it. You're going to get dividends every year, you're going to get share buybacks, you're going to get revenue growth, and people are not going to stop buying Coca-Cola. That said, it is a boring company to own. Not a lot changes in it. They might buy out a smaller brand or they might make a huge management change every year or two. Other than that, not a lot changes with Coca-Cola. When you're a company like Apple, they're constantly coming out with new services and products with a new Apple credit card and their new 5G revolutionary cell phones. There's all different types of things to get excited about with Apple. So the tech sector is generally speaking the most exciting sector because it's the most new and it's one that adapts most quickly. And then the last but not least, similarities. History tends to repeat itself. It doesn't matter what we're talking about here. It doesn't matter if we're talking about governments, if we're talking about leaders, talking about human behavior. History tends to repeat itself, and we'll see if we have a similar situation here with Apple stock and a lot of these other tech giants and see if they'll have a similar downturn that happened in 2000 that might happen here in 2020. So let's look at some of the differences here. Tech is much more advanced today. So a lot of the tech companies today have billions, tens of billions of profits like an Apple and a Microsoft. Now, a lot of the tech companies in the dot-com bubble weren't even tech companies. They were literally putting .com behind their name just to get people excited about it, or they really didn't have any business models. They just basically promised a bunch of returns to shareholders. So a lot of the tech stocks today are a lot different. A lot of them have significant revenue growth, a lot of opportunity, and are a lot different than that of the 2000 .com bubble. Past returns reflect nothing for future returns. So let's go ahead and give an example here. We've been talking about Amazon for a while now. Now, if you see here, Amazon went up and up and up and up and up until 2018. It hit 2,000. If you bought here in September, August of 2018 at 2,000 a share, you wouldn't even start to get significant gains on your portfolio for a full year. It's not until the year later, that we're starting to see pretty good gains. It pretty much traded flat. So if you're buying Amazon stock at 2,000 and then it goes down here to 1,500, are you going to sell out? Are you down 25%, 30, 40% on your money and say, oh, I got to sell out. This is going to go down and it's going to crash. Now, that doesn't predict the future returns as it went right back up to 2,000 and now we're at 3,000. So regardless as to whether or not you're talking about a stock that's went up a bunch or a stock that went down a bunch, it's not about where the stock is at today. It's where the stock is going to be in the future. And then the third section is tech is usually the hardest hit sector in a recession. This is completely different. In the 2000 .com bubble and just most recessions in general, you can see that a lot of times, a lot of these stocks are the most hardest hit sector in a recession. You can see a lot of these are actually the complete opposite, the ones that are holding up the market. The reason why this tech sector is going up so high is because these tech giants are thriving in this recession. This is a unique recession and all crashes are different, but these tech stocks are thriving in this recession. So this is a huge difference here than what is normal from a recession. Tech is becoming defensive safe haven stocks. A lot of people, when they get scared about a recession, about a market downturn, they start buying those Coca-Cola stocks like we mentioned. A lot of people start fleeing these stocks and buying it like crazy to try to protect themselves from a market recession because they're predictable returns. Now it's getting a little opposite. People are looking at Apple as a defensive slash safe haven stock because this is a safe place to put their money that is going to be predictable even in a recession. So this is completely different from the 2000 .com bubble. Profits for some companies legitimized. Now, like I said with some of these, now a lot of these stocks don't have any profits or they do have incredibly horrible valuations. But for some of these companies, these are legitimized. A company like Apple has billions and billions and billions of dollars worth of net income. So that has completely legitimized the growth of this company. It's just for some of these that are getting out of hand. So that is a lot different from that of the 2000.com bubble, including Apple. A lot of these tech stocks had basically no profits worth of them. The last section here, tech now is a need-based necessity. Now, it's not, quote, a need-based necessity, but for a lot of people it is. For a lot of people to go without Wi-Fi, for a lot of people to go without a cell phone, for them, they consider that a need. For me, I consider that a need as well. For a lot of companies, they cannot survive without Wi-Fi and software and IT. There's a lot of things that a lot of companies cannot survive without, and a lot of people cannot survive without, so it is becoming more and more of a need-based product. But overall, guys, that pretty much wraps it up with my opinion on these stocks and the market bubble in general as to whether or not we're going to crash. It is really hard to look at these performances on these stocks, especially with the two that I own, Apple and Microsoft. It's really hard to look at this chart and not want to sell out, but I'm a believer in these companies and I'm a dividend investor anyway, so I'm not really too focused on it. I'm going to keep owning these stocks, and for me to sell out, they would probably have to start getting to ridiculous levels. But overall, guys, my portfolio is doing very good, and I'm doing very good on the channel. And if you watch all the way to the end, if you're interested in signing up through M1 Finance, go ahead and use this referral link right here. We've had 16 different people sign up, and this link is in the description. And in the description, there are several other links in there, as well as a lot of information about me and some other stuff that you need to look at. So go ahead and look at the description whether or not you want to sign up with M1 Finance. But if you do sign up with M1 Finance, you can go ahead and get $10. But go ahead and leave me down a comment down below what you thought about this video, what you think about a lot of other tech stocks. Are they overvalued? Are we in a bubble? Or do you think they have a lot more room to run? So thank you guys so much for watching, and I'll see you next time.